Ghana, making all the headlines. The Bank of Ghana deciding to raise its policy rate by 100 basis points, 28%, looking to rein in inflation and a wobbling Cedi. Bank of Ghana Governor Dr. Ernest Addison provided a briefing at the end of the monetary policy meeting. Analysts were expecting a 200 or higher basis point increase. But let's get to Fred Duvor, who is Managing Director of Apakan Securities, joining us from Accra. Fred, good to see you again. Good morning. Were you surprised by the 100 basis point move when analysts expecting, at least in the Bloomberg survey, 200 basis points or higher?
Well, I mean, I was not really surprised. The central bank, I know, is aware that inflation started getting out of control last year, and I'm sure they're aware that there's going to be a lot of base effect play this year when it comes to inflation. Last year, there was about 1,250 basis point cumulative increase in the policy rate, and we still ended up with a year-end inflation of about 50%. So, I mean, what we have is inflation data, as we know, is lagged, and policy rate is more forward-looking. So I believe the MPC's inflation expectation may not be as dire. So this may probably inform the 100 basis point increase. They expect that inflation further down the year may trend down. So they're being cautious. And they also have an eye on growth. So they try to keep that balance between managing inflation and general economic growth.
Fred, it's a tight balancing act. I mean, you know, year-on-year inflation, what is it, 54 no, sorry, also December, 54.1. I mean, if you look at NPR at 28%, the real, I guess the negative real return is, I guess, one of the highest in the world, looking at, you know, Ghana's troubling metrics here. So, and then the inflation ceiling, 10%. Is monetary policy, is it working, or, you know, how do you see it?
Well, I mean, to be honest, I believe that monetary policy has its limitations in controlling inflation in our economy. Because we are so import dependent, the dynamics of our currency may have a much bigger effect on inflation than monetary policy, in my opinion. In 2020, 2021, where we had a single-digit inflationary environment or close to that, the Cedi experienced just about a 3% and 4% depreciation, respectively. So when we have a stable currency, inflation remains stable. If the policy rate, I believe, if the policy rate is even increased to 50, 60% and the Cedi depreciates steeply, we will still have a high inflationary environment. And that is the sad truth, but we have to live with it. So that is, however, not to say that policy rate does not have an impact. I just believe that there is a limitation to its effect on controlling inflation. And if the central bank is able to arrest the depreciation of the Cedi, it should have a better control over inflation. But what we have now, or what we experienced last year, was very steep depreciation of the currency, and that translated heavily into the inflationary environment that we experienced. And we have seen that path this year. January, the Cedi has depreciated by 12%, and we're seeing that translate into what inflation is for January.
Now, I mean, you said this earlier. You alluded to the MPC's outlook for the rates. You said, you know, that they think they have an eye on growth. They believe that inflation may moderate, decelerate, you know, as the year goes on. Well, what's your outlook? Do you agree with that? How do you see, you know, are we going to see more hikes, you know, subsequent meetings? You know, do you agree that with what they're seeing, that inflation may trend downwards? How's your outlook there?
I mean, like I mentioned earlier, if the Cedi continues on the path that it has taken this year, I think 12% already year to date, then I think we will most likely see another measured increase in policy rate in March, maybe 50 basis, 100 basis, depending on the intensity of the depreciation. But if one thing I know is that because inflation galloped last year, the CPI base will be higher, much higher this year, and that will come, which may augur well for the inflation numbers this year. Also, following a successful board approval of the IMF facility, I expect that the currency should be relatively experience some stability from Q2. Then that should translate into a managed inflation environment. So I believe this in the second half of the year, we should see inflation trend downward and possibly some rate cuts as well. But that would only be if this monetary policy expects that inflation has inflation expectations well anchored.
Okay, great. I'm glad you mentioned the IMF because, well, Bloomberg's reporting that the IMF has asked the government of Ghana to stop borrowing funds from the Bank of Ghana. The estimated borrowing is to the tune of about $3.2 billion, according to whichever sources that they spoke with. We're having the same issue here in Nigeria where, we've got our own ways and means borrowing from the federal government, borrowing from the central bank. So what do you make of this development here?
I mean, Ghana and Nigeria are siblings, so I'm not surprised. But yeah, I mean, I believe this ties in generally with IMF's concern about our debt situation. For some time now, the government has been locked out of both the international capital market and the local capital market as well. It's not been able to issue bonds locally, and because of where Ghana Eurobonds are trading, it's unable to go to the international capital market to raise funding. So it has resorted to borrowing from the central bank to finance its debt obligations that are maturing and also finance the budget deficit. I think the IMF's worry is that if this is not checked, the government spending overruns will continue. And already the central bank by law is only expected to finance the government up to 5% of the previous year's total revenue raised, and it is currently in breach. So I think the IMF is right in taking this position and seeing that we are trying to get a board level of approval. It's advising the government against this, anything that may probably hinder us securing that approval for the facility.
So yeah, speaking of which, are you optimistic that, I don't know, we're already in February, is there end of the month, maybe March, or when do you think that loan is going to come through?
Well, I think the president last month said that he hopes a deal with the fund will be sealed in February, but I think that is overly optimistic. I believe the board approval with the IMF will happen not earlier than in Q2. I expect finality on this in April at the earliest, but it is more likely going to be in some time in May, in my estimation. However, if the president may know something that the market doesn't know, I don't know. So if it does happen in February, as he has mentioned, it will be fantastic for the country and for our economic situation.
But Fred, I think I've asked you this before. Is the money enough when you think of looking in totality? Is that $3 billion enough?
I mean, $3 billion is not enough. But I guess what we are facing now is that we have serious balance of payment challenges. The central bank's reserves has dwindled significantly, and what that $3 billion is for is to help the balance of payment situation. So we don't want a situation where the country runs out of reserves and is unable to import goods and services and all of that. So I think that is what is primary on the mind of the government. And for where we are at, I think $3 billion should help in shoring up our reserves and keeping the country running till we find a more lasting solution to our economic woes.
All right, so based on that, does that bode well for the Cedi? You mentioned the Cedi already, the currency, but just to put a button on that, you're optimistic for the Cedi's progression this year? How does that look?
A lot of that depends on how soon we get this deal done. Already, we've seen the Cedi depreciate by about 12% in January, and the central bank, like I mentioned, is running out of reserves. I think it's currently a little over 2 months of import cover that we have. We see that the central bank has already suspended FX support for non-essential imports. So the risk points to the depreciation of the Cedi is quite real. However, if IMF comes in with its balance of payment support, I expect there to be enough dollars to help sustain the city. I don't expect us to experience what we experienced last year with respect to the depreciation. I think we had some good fortune in December where there was a bit of appreciation. So we closed the year with around a 32% depreciation. But I don't expect us to experience that level. I would put it at maybe early to mid-teens depreciation for 2023.
Great stuff. Just a couple of minutes ago, I guess, just rounding everything up, the outlook for the economy then, are you cautiously optimistic or neutral? How do you see things for the economy?
I'll say I'm cautiously bearish. But I mean, it's like I said, everything now is looking at how soon the IMF comes in. And it's not even, the IMF coming in is not even just for the facility. It's going to restore some investor confidence. And that effect will mean that we should see a little bit more of foreign investor money coming back into the economy. And so that confidence that the IMF being here brings into our economy is much needed. Now, how soon we get the IMF deal done will determine how well things will play out in the economy this year. But if we get it done early, then things should be relatively better this year. But I have no doubts that towards in Q3, Q4, we should see some metrics like inflation and the likes tapering, and that should bode well for our economic woes.
All right, fascinating stuff. Ghana making all the headlines, and we're glad we have you to give us a direction where things are going. Fred Duvor, Managing Director, Apakan Securities, thank you so much for talking to us. We appreciate your time.